Hey everybody, welcome back. My name is Scott Newhouse. Thank you so much for joining me. Shout out to you and the dozens and dozens of people all across the country that are tuning in. I really do appreciate it. So today I want to talk about something that's very, very important, and it relates to your tax planning, especially as you are close to and in retirement. And so what am I talking about? I'm talking about something called the gap years. The gap years are really a fantastic opportunity for you to take advantage of smart tax planning that can lower your lifetime tax burden. And since you're lowering your tax burden, you're also going to potentially increase the money, the investments that you're able to keep for yourself, and that's going to increase your odds of long-term financial security throughout your retirement. So really important stuff. Before we get into that, I have a little bit of a trivia question that relates to this episode, which is, what do you think the average retirement age is in the US? I'll give you 5 seconds. Think about it. Just shout it out at home, in your car, wherever you're at. Just give me a guess. Average retirement age in the US. 3, 2, 1. Okay, time is up. The average retirement age in the US is actually only 62 years old. Personally, when I was looking that up, I was surprised. I thought it'd be 65. That's the traditional number that we all hear, that we kind of associate with retirement. But for a lot of reasons, some people retiring earlier, some bad reasons, like people kind of losing their job and then not, kind of having some age discrimination and not being able to get back into the workforce. They kind of have to have a forced retirement. So it's a little bit lower than what I thought, but 62 is what we're working with. And you'll understand why that's important in a second. But let me explain to you kind of how this episode's going to go. We're going to talk about what the gap years are, why they're important, two really main strategies that you need to think about during that gap year, during these gap years, and then also some things to watch out for. So let's jump right into it. What are the gap years? The gap years basically refer to that time period when you stop full-time work. So again, let's just say 62, average retirement age. You stop full-time work, but you still have years left until two different things, which would kind of conclude the gap years. And those two things are taking Social Security, which you all know you can take Social Security from 62 all the way up until age 70. So we're assuming you're going to delay Social Security until 70. And then RMDs, required minimum distributions, which you're actually now allowed to start taking those at age 73. So that's been pushed back a couple years from what it was prior. So the gap years are basically that time period when you stop full-time work. Again, let's say age 62, and then let's say you delay Social Security until age 70, and RMDs in 73. So you'll basically have 8 years of quote unquote gap years. And let me talk about why this is important. Since you will not have full-time earned income at your normal job, your taxable income is going to be a lot lower, which means your tax bracket's going to be a lot lower. And so it's going to present an opportunity where you're going to be in a much lower tax bracket than what you are used to. And that's going to make it ideal for you to strategically take advantage of some tax planning opportunities. So why are the gap years important? And I kind of messed this up because I've already said a little bit of it. But one, there's tax saving opportunities. If you are married filing jointly, you can earn up to $94,300 and still stay within that 12% tax bracket. That's a phenomenally low tax bracket. Historically, that's a really low tax bracket. So that's just really a lot of income that you can earn at not high of rates. So that's fantastic. Two, if you lower your taxable lifetime burden, then that just means that you're going to be able to keep more of that money, which means you're going to keep that invested, which means it's going to increase the odds of your retirement success, you having the money that you need for the rest of your life. It's also going to help minimize future tax burdens because, again, with these tax strategies that we're doing, we're basically taking care of some of the tax burden during these gap years from 62 to 70, let's say. And so you take care of it now, you don't have to worry about some of the tax burden later, which means future tax burdens by, a president and Congress raising taxes at some point in the future, you don't have to worry about it because you've already taken care of it during these gap years. And then the fourth reason why I love the gap years so much is that it presents so much flexibility. Every single year, you're going to get a wide open slate in terms of what you want to do. And so one year you might do this tax strategy, another year something comes up and you can't do the tax strategy, but maybe you can do something else, and on and on and on. You're just going to have so many different options during these gap years if you retire before age 70. So let's talk about two of the best tax strategies that you can utilize during the gap years. The first one will not surprise you if you've listened to this show, and that is Roth conversions. For those of you that don't know, a Roth conversion is basically if you've got a traditional IRA, so it's pre-tax money, you haven't paid taxes on it, and you convert it to a Roth IRA, you have to pay ordinary income tax on the dollar amount that you can convert over to the Roth IRA. Now, the good news though is that even though you have to claim that income in the current year that you convert it, you're going to be paying that at typically a much lower tax rate than what you were at before. And then also, as long as you follow all the rules, you move the money from traditional IRA to Roth IRA, grows tax-free, and then you're going to be able to take it out tax-free in the future. Again, you got to follow all the rules, but that's a really great situation. Also, I talk with a lot of people, and these are, this describes some of the people I talk to as well as some of the people that I work with. But let's say you and your spouse have way too much money in a savings account, and I'm talking like maybe 4 or 5 years of cash savings, just like way too much cash, and you're early in the gap years, and you've also got a significant amount in your investment accounts, especially your pre-tax investment accounts, because we have to remember the Roth IRA didn't get invented until the 1990s, and then the Roth 401k, I don't even think that was an option until the mid-2000s. So a lot of the people that I'm working with in their 50s and 60s, they just, they weren't aware of it, or it just never really made sense for them to take advantage of the Roth accounts because their income was so high. And typically, if you're lower income, it makes more sense to contribute to a Roth IRA, whereas if you're higher income, maybe it doesn't make as much sense. So you get the gist of it. A lot of the people that I talk to have a lot of money in pre-tax accounts. So in this example, let's say you want to convert from pre-tax to Roth. You want to utilize those Roth conversions during these gap years, and then you also want to spend down some of the extra cash that you have in the savings account. Well, you're going to be able to solve multiple problems in 1 year by spending the cash for your living expenses, doing the Roth conversions at the lower tax rate, and then since you don't really need to incur any other income to get the money you need since it's coming from the investment accounts, that tax bracket that you're doing on the Roth conversions, it's going to stay fairly low. So that's just one scenario that would have applied to a lot of the people that I talk to and work with. Let me talk about a different strategy though during the gap years, which is tax gain harvesting. I've talked to a number of people that this applies to as well. And so tax gain harvesting is the opposite of tax loss harvesting, which you might have heard about, where basically if you have a loss in a taxable non-retirement investment account and you sell it you sell that investment at a loss, which no one likes to do, but if you sell at a loss, you can actually take the losses and use it to offset income throughout the year. And there's a lot of different rules, but it can either offset capital gains that you have on other investments, or it could offset your ordinary income up to $3,000 a year, and then after that you got to carry it over. But that's tax loss harvesting, so that's one thing to think about, but that's not really germane to this discussion. I want to talk about tax gain harvesting, which applies to a lot of the people that I'm working with because stock market's done really well the last 3+ decades. And so a lot of the people that I talk to, they have appreciated stock positions, which means that they've got a lot of capital gains in their investment accounts. And so one thing that a lot of people don't know is that if your income is below a certain level, and let me just read out the numbers, in 2025, if you're single and your income is below $47,025, or if you're married filing jointly and your income is below $94,050, then you can actually sell your capital gains, appreciated stock, appreciated index funds, or mutual funds. You can sell at a 0% federal tax bracket. And that's really an incredible, I don't want to say cheat code because it's not cheating at all, but it's an incredible opportunity if you've got appreciated assets in those taxable investment accounts. You essentially get to reset the cost basis of your assets without having to pay taxes, federal taxes, and that's going to save you a lot of money throughout your lifetime. And you just consider that versus selling it while you're still working. And let's say, I don't know, if you're making, any kind of money, you're capital gains tax rate is going to be 15%. So you're saving that 15% that doesn't have to go to the government. You got to keep it and reset your cost basis a little bit. And so it's really a fantastic opportunity to think about that if that applies to you, if you've got some gains in those taxable accounts. One thing that I've mentioned before is that if you want to take full advantage of the gap years, it just makes the most sense to delay Social Security up until age 70. Simply because the more income that you have, the less options we're going to have to fill up those tax brackets at the 10%, 12%, 22%, etc. So if you've got Social Security income coming in, it just whittles down how much we're able to take advantage of a Roth conversion or the tax gain harvesting. And then also, you need to be strategic with your withdrawals, especially if you're taking withdrawals from your IRAs or 401ks, because any income that you incur from those, it's also going to whittle down and lower what you're able to take advantage of in terms of gap year planning opportunities. So now I want to run through just some common pitfalls, some cautions that you need to take while you're planning for these gap year opportunities. Number one, you've got to watch out for tax bracket creep. You don't want to accidentally convert too much or incur too many capital gains that it bumps you up into a higher tax bracket. So you've got to use either tax planning software or work with some kind of CPA, CFP, certified financial planner, just to model out scenarios and do your best guesstimate, which should be a strong estimate of where your income is going to be for that year, and make sure that you don't go over whatever numbers that you don't want to go over. The second thing you need to be on the lookout for is Medicare premium surcharges, also known as IRMAA. So essentially, income from gap year strategies could affect your Medicare premiums. The way it works is if you're age 65, whatever your taxable income is in that year, then 2 years later, i.e. when you're 65 and on Medicare, that's when they would charge you the premium surcharge. So it's just a 2-year delay, and then you will have to pay some kind of Medicare premium if you go over certain amounts. For 2025, the surcharges are single above $103,000, and married filing jointly $206,000. So if you are going to be doing any of this, especially the Roth conversions, I don't necessarily say that it's the worst idea ever to incur the IRMAA charges. I don't want it to be a surprise. And so you might look at everything, look at your entire financial situation and say, you know what, it makes sense for me to do these Roth conversions, get that higher taxable income, and just pay that money now, knowing that I'm going to have a 12-month period where my Medicare premium is higher than what I would like it to be. But the benefit is you do a higher Roth conversion amount. So it might make sense for you. It's definitely not all or nothing on my end. I don't think that way with the Medicare premium surcharges, but I don't want it to be a surprise to you. The third thing that you really need to plan for is liquidity needs. If you're going to be doing any kind of Roth conversions, you've got to be able to pay the taxes on it. And if you're going to realize any kind of gains, even if you have, low, either a 0% or 15% capital gains tax on that money, you've got to be able to be ready to pay the extra income tax liability. My fourth point is state taxes. You've got to know what your state income tax rules and regulations are. So when you're doing those Roth conversions, when you're incurring capital gains, it may not be exactly what the federal tax rules are with that. So you've got to research your state laws, or again, work with an advisor who is familiar with your state income taxes. And then the fifth point that I've got for you is that these can be very complex. There's a lot of moving parts. Boy, unless you're really, really, really confident that you're considering everything, that you're thinking through all of this clearly, personally, and I know this is biased because I am a financial advisor, but I really encourage you to at least talk to a financial advisor or some kind of CPA, and honestly, probably not a CPA just because they're more focused on the tax side, whereas a certified financial planner's focused on taxes, but they're also focused on like your lifetime retirement income and your entire financial picture. So I'd probably work with a certified financial planner, but I'm biased. I am a certified financial planner. My point is I want you to know what you're doing and make sure you don't make any costly mistakes because you didn't know the rules, regulations, no surprises. I hate surprises when it comes to this kind of stuff. So I think the gap years are a really fantastic opportunity for a lot of retirees. I just hope that you realize that this window, maybe from 60, maybe from 62 or 65, 65 all the way up until age 70. It can reduce your tax burden, it can extend your savings, and it can improve your long-term financial outlook. But you've got to plan ahead for it, you've got to know what you're doing, and then you've got to take action on it. If you think I could help, go to forthrightfinances.com, book a free call with me. I'd be happy to help, and I will see you next time.